Hey, welcome. Today, we're going to break down a really big topic, how the health of our planet is directly connected to the health of our finances. We're talking about the financial risks of climate change, and trust me, they're very real. So let's dive in. This sounds like something straight out of a Hollywood movie, right? But this isn't fiction. This actually happened, and it's the perfect way to frame what we're talking about today. How can an event like a wildfire ripple out and cause such massive real-world financial damage? Okay, so at the end of the day, this is what it all comes down to. We're not just talking about the environment anymore. We're talking about economics. We're talking about climate risk. And that's really just a way of saying this is how climate change hits the bottom line. It can tank the value of assets, make loans go bad, and shake the very foundations of companies, banks, you name it. To really wrap your head around this, it helps to think of it like a simple equation. See, climate risk isn't just one thing. It's what happens when you multiply three key factors together. You start with a hazard, like a storm or a driver, like a new policy. You multiply that by an asset's exposure, and then you multiply that by its vulnerability. We're going to unpack each piece of this. So, here's the game plan. First, we'll look at the two main types of risk. Then we'll get into those factors that make them worse. We'll talk about the ultimate price tag, something called stranded assets. See how this stuff actually spreads through the economy. And wrap up with the really crucial human side of all this. All right, let's jump right into part one. When we talk about climate risk, it helps to think of it as having two very different faces. On one hand, you've got physical risk. This is the one we can all picture pretty easily, right? It's the direct damage from things like hurricanes, heat waves, wildfires. But on the other hand, you have transition risk. Now, this is fascinating. It's the financial risk that comes from the solutions to climate change. It's the risk created by the huge economic shift we have to make to get to a net zero world. Think new laws, breakthrough technologies, or even just what customers want. Okay, let's dig a little deeper into physical risk. It really comes in two flavors. You have acute hazards. These are these sudden, dramatic events we see on the news, like a flood or a wildfire. But then you have chronic hazards. These are the slow burn problems, the long-term shifts that creep up on you, like sea levels quietly rising or average temperatures inching up year after year. So what about transition risk? What's pushing that? Well, there are four main engines here. First, policy and legal stuff, like a government suddenly creating a carbon tax. Second is technology. What happens when solar and wind get so cheap they make old power plants totally obsolete? Third is the market itself. Investors and customers voting with their wallets. And finally, reputation. You do not want to be seen as the bad guy because that can seriously hurt your business. Okay, let's move on to the next part of our risk equation. A hazard, or a driver, is just the starting point. The real impact comes from two crucial multipliers, exposure and vulnerability. Exposure is the first one, and it's pretty simple. It's just asking the question, are your assets in the line of fire? A factory built on a low-lying coast is obviously exposed to sea level rise. A coal company is exposed to new carbon taxes. It's all about being in the wrong place at the wrong time. But being exposed isn't the whole story. That's where vulnerability comes in. It's all about how ready you are for that hit. Okay, check out this example because it makes it super clear. Imagine you have two identical factories, both in a flood zone, so they have the same exposure. But one of them has invested in flood pumps and defenses, and the other hasn't. The one without the pumps is way more vulnerable. It's going to get hit so much harder. That's the vulnerability factor. So, when a hazard hits an asset that is both exposed and vulnerable, what's the financial outcome? Well, that brings us to a concept that is absolutely critical in climate finance, the stranded asset. So, what is a stranded asset? Basically, it's something that loses its value way, way sooner than anyone expected, all because of climate risk. It could be a brand new power plant that has to be shut down, or a beautiful beach house that nobody can get insurance for anymore. Its value is just gone, stranded. And this really matters because a lot of our pension funds and retirement savings are invested in these kinds of assets. And it's so important to get this. We're not just talking about buildings and machines here. Sure, a coal plant is the classic physical stranded asset. But you can also have intangible assets stranded. Think about a person who has spent their entire life perfecting a skill for an industry that's about to disappear. That person's human capital, their expertise, can become stranded too. Okay, so we've got the equation and we know the potential outcome. Now, let's connect the dots and see how this risk actually spreads through the economy, hitting major industries and, eventually making its way to all of us. This chart lays it out so clearly. Look at real estate. The physical risk is that your seaside property loses value, but the transition risk? That's when your building with a bad energy rating suddenly becomes worth less. Same for electricity. Physical risk is being held liable for starting a wildfire. Transition risk is your old coal plant being unable to compete with cheap solar power. And if you want to put a real number on this, just look at this. $22 billion. That's how much the oil company Shell had to write down in assets in just one quarter. And this wasn't from a hurricane or a flood. This was pure transition risk. The company basically admitting that a bunch of its oil and gas was probably going to have to stay in the ground. Which brings us right back to our very first question. The PG&E Anchor bankruptcy in California is the ultimate case study in physical risk. The company was found liable because its equipment sparked these absolutely devastating wildfires, which were made worse by hotter, drier conditions. So you see how it all connected? A chronic hazard, the climate changing, led to an acute disaster, which created a massive financial liability. Hazard, exposure, and vulnerability, it all came together. The financial fallout is obviously huge, but this whole story doesn't end with a corporate balance sheet. And that brings us to the last, and maybe the most important piece of this entire puzzle, the people. This is where the idea of a just transition comes in. It's the simple idea that this massive shift to a greener economy has to be fair for everyone. It's about acknowledging that whole towns, whole workforces have been built around industries that are going to shrink or even disappear. So it's about being proactive, creating things like job retraining programs to support the people who are most at risk from all these changes. I think this quote from Annabella Rosenberg just hits the nail on the head. What she's saying is that people losing their jobs isn't an automatic result of taking action on climate. It's a result of a failure to put the right social supports in place at the same time. The pain isn't inevitable, it's a policy choice. And that really leaves us with the big question, doesn't it? We get the risks now. We see this huge economic shift is already happening. So the challenge ahead, for our leaders, for companies, for all of us, is how do we manage this change so that we protect the climate and we protect people? That's the real work. Thanks for tuning in.